Ever wondered how the wealthy seem to grow their money effortlessly? What if I told you the secret isn't just hard work or sheer luck, but something much more accessible to everyone? Today, we're diving into the magic of exponential growth in finances. Imagine this. You plant a single seed in the ground. This seed represents your initial investment. As time passes, that seed sprouts and grows into a tree. But it doesn't stop there. The tree bears fruit, and each piece of fruit contains seeds of its own, which can also be planted to grow more trees. Soon, you have an entire forest from just one seed. That's the power of exponential growth. Each step of growth multiplies the previous, much like how smart investments can multiply your initial capital. Intrigued? Let's explore how you can harness this power to not just save, but truly multiply your money exponentially. Stay tuned as we break down the fundamentals, strategies, and smart moves you can start making today. The power of compound interest. Imagine planting a tree in your backyard. At first, it's just a small sapling. But over the years, it grows taller, sprouts new branches, and those branches sprout even more branches. Compound interest works in a similar way with your money. Here's the straightforward formula. Compound interest is the interest you earn on both your original money and on the interest that money has already earned. In other words, you earn interest on interest. Let's break this down with a simple example. Suppose you invest $1,000 at an interest rate of 5% per year. In the first year, your investment grows by $1.50, so you now have $1,050. In the second year, you earn 5% not just on your initial $1,000, but also on the $1.50 interest from the first year. This means in the second year, you earn $52.50, bringing your total to $1,102.50. This process continues each year, and your investment grows exponentially over time. To see the true power of compound interest, consider what happens over longer periods. If you leave that initial $1,000 untouched for 20 years, you don't just double your money. You end up with about $2,653.30. Extend that to 30 years, and you'll have around $4,321.94. And in 40 years, that modest $1,000 becomes $7,039.99. It's clear. The longer your money can grow through compound interest, the more substantial your returns become. It's not about starting with a huge sum. It's about giving whatever amount you can, invest the time it needs to blossom. Fundamental strategies for exponential growth. Ready to unlock the secrets to growing your wealth exponentially? Let's explore 3 powerful strategies: investing in the stock market, diving into real estate, and leveraging tax-advantaged investments. Each of these approaches offers distinct advantages that can supercharge your financial growth. Stick around to learn how to make your money work harder for you. Investing in the stock market. First up, the stock market. An incredibly popular path for investors aiming to grow their wealth. The key to success here starts with understanding the basics. The stock market is a platform where shares of publicly traded companies are bought and sold. By investing in these shares, you become a part owner of these companies. But it's not just about buying stocks, it's about smart investing. Long-term strategies are crucial. While markets can be volatile in the short term, they have historically trended upwards over time. So patience really pays off. Another critical strategy is diversification. By spreading your investments across different sectors and types of assets, you can reduce risk and stabilize your returns. Real estate investment. Investing in property can offer solid long-term returns because of the dual benefits of capital appreciation and rental income. Think about it. Real estate values generally increase over time, and renting out properties can provide a steady stream of passive income. For those starting out with a smaller budget, consider investing in a small property or joining a real estate investment group. Even modest investments can begin your journey toward generating significant passive income. Retirement accounts and other tax-advantaged investments. Lastly, don't overlook the power of tax-advantaged investments like IRAs and 401ks. These accounts offer tremendous benefits because they either defer taxes on the money you contribute until retirement or allow your investments to grow tax-free. Maximizing your contributions to these accounts can dramatically increase your investment growth thanks to the tax savings. Over the years, this can compound and lead to substantial wealth accumulation. By employing these strategies, investing in the stock market, diving into real estate, and maximizing your tax-advantaged accounts, you set the stage for your money to grow exponentially. Remember, the key to exponential growth is starting early, staying consistent, and continually educating yourself on financial strategies. One incredible way to potentially grow your money exponentially is through starting your own business. When you own a business, you're not just working for a paycheck. You're building an asset that could multiply in value and generate income for years to come. First, let's understand the difference between passive and active income. Active income is what you earn from your day-to-day job. You work an hour, you get paid for that hour. On the other hand, passive income is money you earn without being actively involved all the time. This could come from a business you've started that now runs with minimal daily oversight, allowing you to make money while focusing on other ventures or even while you sleep. Now let's take inspiration from those who started small but made it big. Consider the story of Sarah Blakely, the founder of Spanx. She started her business with just $5,000 in savings and a simple idea to make undergarments that seamlessly shape the body. Sarah's initial investment was minimal, and she kept her day job while building Spanx during nights and weekends. Today, Spanx is $1 billion company, and Sarah is a self-made billionaire. Then, there's the story of Michael Dell, who started assembling computers in his college dorm room with less than $1,000. His venture, Dell Technologies, turned into one of the largest tech companies globally, showing how starting small doesn't mean thinking small. These stories underline that with a good idea, determination, and the right strategy, starting your own business can not only provide active income, but also build a substantial source of passive income over time, contributing significantly to your financial growth. Cryptocurrency and tech startups. Cryptocurrencies, like Bitcoin and Ethereum, are digital currencies that operate independently of traditional banks. The appeal. They offer high returns at a speed that traditional markets rarely match. For example, early investors in Bitcoin saw their investments multiply by thousands in just a few years. But remember, the crypto market is highly volatile. Prices can skyrocket, but they can also plummet just as quickly, posing a significant risk. Moving to tech startups, these companies are on the cutting edge of innovation, often working with the latest technology to disrupt traditional industries. Investing in a startup can be exhilarating, especially if the company grows to become a household name. However, it's crucial to understand that many startups fail and investors could lose their entire investment. So, how should you approach these high-risk opportunities? First, do your homework. Research thoroughly. Understand the market trends and know the risks involved. Never invest more than you can afford to lose, and consider diversifying your investments to protect yourself from unexpected downturns. Maximizing your investment capital. To invest, you need capital. And the best way to increase your investment capital is by saving effectively. First, assess your financial health with a simple budget. Track your income and expenses to understand where your money goes each month. Tools like budgeting apps can automate this process, making it easier to stick to your financial goals. Next, focus on maximizing your savings rate. Cut unnecessary expenses and consider ways to increase your income. Remember, every dollar saved is a dollar that can be invested towards your future. Lastly, Don't overlook the importance of an emergency fund. This is your financial safety net, meant to cover unexpected expenses like medical bills or car repairs without needing to dip into your investments. Aim to save enough to cover 3 to 6 months of living expenses. By mastering the art of saving, you free up more capital to invest, paving the way for financial growth and security. So start today and watch your investment potential grow exponentially, avoiding common pitfalls. First, one of the most frequent mistakes is emotional investing. It's easy to get caught up in the hype of a hot stock or to panic and sell when the market dips. To avoid this, set clear, long-term financial goals. Use strategies like dollar cost averaging, where you invest a fixed amount regularly, regardless of the market's ups and downs. This approach not only reduces emotional decision-making, but can also smooth out your purchase price over time. Next, let's talk about high-interest debt. It's like a hole in your wallet, draining your resources faster than you can fill it. If you're carrying balances on credit cards or high-interest loans, prioritize paying these off. Strategies like the debt avalanche, where you pay off debts with the highest interest rates first, can save you a lot of money in interest over time. Continuous education. Moving on to continuous education, staying informed is crucial. The financial world evolves rapidly, and keeping abreast of changes can help you make better investment decisions. Dedicate time each week to read financial news, listen to podcasts, or even take online courses. There are excellent resources out there. For instance, books like The Intelligent Investor by Benjamin Graham, or online courses from platforms like Coursera or Khan Academy that focus on investment basics. Seminars and webinars hosted by financial experts can also provide valuable insights and up-to-date market trends. Lastly, always be ready to adapt. What worked yesterday might not work tomorrow. Regularly review and adjust your investment strategies to align with current market conditions and your personal financial situation. Remember, the goal is not just to grow your money, but to do so in a way that fits your changing needs and goals. Thank you so much for spending your time with us today and diving into the exciting world of growing your money exponentially. If you found this video helpful, please consider subscribing to our channel and sharing this video with friends and family who might benefit from these financial strategies. Don't miss out on more content like this. Hit that subscribe button and turn on notifications to stay updated. We've got plenty more tips and tricks coming up that will help you build on what we've discussed today and continue to optimize your financial growth. So, stay tuned and let's keep growing together. See you in the next video.